Welcome to the Opening Bell Report.
If you've been following the markets at all since the calendar flipped, you know exactly what the defining storyline is.
Oh, absolutely.
I mean, this aggressive, almost relentless rally in tech stocks. We're talking about a tremendously powerful start to the year.
Driven by momentum, high optimism, and that whole January effect thing.
Right. But while all those screens have been painted green, there are these growing whispers, this nervous chatter about, frothiness creeping back into valuation.
The analysis you shared with us, it zeroes in on this exact scenario.
Yeah.
The thesis is that this tech euphoria is setting the stage for a sharp, short-term reversal. And they name a very specific tool for it.
So we're not just talking about a general bearish feeling.
Yeah.
We're looking at a specific, targeted, even leveraged trade.
Exact.
The tool is the ticker symbol, SQQQ.
That's right, SQQQ. It stands for the Pro Shares Ultra Pro Short QQQ.
Right.
For simplicity, it's a leveraged ETF. And because it's short, its value moves, well, inversely to the NASDAQ 100.
Which is where all the big guns live. NVIDIA,
Yeah.
Apple, Microsoft.
Whole crew. So the analysis we reviewed has a crystal clear sentiment. They are bullish on SQQQ right now.
Which is just a powerful way of saying they are deeply bearish on tech in the short term.
It's an explicit warning shot. It's asking that question right out loud. Tech bubble warning.
Okay, so let's unpack this setup. When someone calls for a reversal right after a huge rally, I mean, the burden of proof is high. Why now? What's the trigger?
Well, the core argument is based on valuation extremes and statistical probability.
The idea that what goes up must come down.
Sort of. It's the law of mean reversion. Markets just don't travel in a straight line forever. The sheer velocity of this rally has pushed valuation metrics, PE ratios for the Magnificent Seven, into territory that is just statistically unsustainable without a pause.
So not that the party's over for good, but that it's due for a breather.
Exactly. A healthy correction.
But, calling a correction is easy. Everyone does it. Timing it is the impossible part. What makes the entry point for this trade so compelling right now?
It's how cheap the insurance has become. That's what's fascinating here.
What do you mean by that?
The analysis highlights that SQQQ is currently trading right around the mid-60s. They specifically point out $66.26.
Okay.
That price is hovering right at the absolute floor of its 52-week trading range.
That's a huge psychological anchor. I mean, the analysis notes the full range is from, what, $63.40 all the way up to $289?
A massive range. So if you're buying at 66, you're basically betting against the tech sector at the lowest possible price point in the last year.
It's like buying hurricane insurance when the sun is shining.
Perfectly put. You're getting maximum potential protection for the minimum price.
And that brings us to the leverage. We have to clarify this for you, because XQQQ isn't a one-for-one inverse fund. That leverage is the engine.
It is the engine. It's a 3x leveraged ETF. So for every 1% move down the NASDAQ 100, SQQQ is designed to move about 3% up.
So if NVIDIA or Apple stumbles just, say, 2% in a day.
The analysis suggests SQQQ could surge 6%. That magnification, that's the explosive potential if their correction scenario plays out.
Of course, that leverage is a double-edged sword, which we will definitely get to in risk management. But first, let's talk catalysts. What could actually pop this bubble?
The sources remind us of a pretty fundamental truth. Stocks don't go up in a straight line forever. Healthy markets need corrections. The story needs setbacks.
So what's the specific jitter on the horizon?
The primary one is coming up fast, Q4 earnings season.
Right.
These mega-cap tech stocks, they've rallied not just on what they've done, but on the anticipation of what they're going to do, especially with AI.
So the market is priced for perfection.
It's baked in. And that's the trigger event the analysis is watching for.
Which is what, exactly?
Deceleration. It's that simple. If any of these tech giants reports slowing growth, and it can still be positive growth, just slower than expected.
That could be the pin in the balloon.
Because those high PE multiples are incredibly sensitive to growth. If that narrative falters, those multiples can compress and fast.
And when that happens, you get a rush for the exit. That bubble, fear spikes, and people rotate into protection.
And in this context, SQQQ is the tool designed to capture that exact volatility.
So the fundamentals are setting the tension.
Like a stretched rubber band. And now we can turn to the charts, which are measuring that tension in real time.
Great transition. So how are the technicals validating this view? It's not just that the price is low. The report says the $64 to $66 level is a critical support zone.
Yeah, historically, this zone is like a magnet for buyers. Every time SQQQ has tapped this area in the past year, it has reliably bounced.
So it's a known floor.
It suggests this is where the professional hedgers step in to buy that cheap protection. The floor has been tested, and it's held.
And what's really compelling is how this price action relates to momentum indicators. Let's talk about RSI divergence.
Okay, so RSI Relative Strength Index, it just measures the speed and change of price moves. Basically, momentum.
And divergence is when two related things tell different stories.
Exactly. Right now, the NASDAQ 100 itself is showing classic overbought signals. Its RSI is likely way over 70, suggesting the rally is running out of steam.
But the inverse product, SQQQ, is doing the opposite.
It's deep in oversold territory. That's the divergence. The market is stretched in one direction, and the chart for the inverse product is showing the tension is ready to snap back. It's a reading of market exhaustion.
And beyond that bigger signal, the analysis points to a very immediate opportunity, the gap down play.
Right. SQQQ recently gapped down to land right at that $66 entry point.
And in technical terms, what does a gap like that mean?
Gaps often act like vacuums. They tend to get filled, meaning the price usually tries to retrace its steps back up to where it was before the gap.
But even if the big correction doesn't happen right away,
that gap still provides a conservative, high-probability first target.
Just a little rally back to 68 or 70 bucks.
Exactly. And that small move alone offers a quick 3 to 6% profit potential, totally independent of any big earnings disaster. It's the logical first step.
Okay, so we have the statistical argument, we have the fundamental catalysts, we have technicals showing an oversold condition. The sources frame all this as an asymmetric risk-reward scenario. But what does asymmetric really mean when you're dealing with a 3x leveraged product?
It means the downside risk from this specific price point is limited and quantifiable,
Okay.
while the potential upside is significantly larger. But, and this is a big but, maintaining that asymmetry requires iron discipline. Because of the leverage, if you're wrong, you can lose money very, very fast.
Which is why the trade management plan is so central to this whole analysis.
It's everything.
So let's look at the entry strategy. They say don't go all in at once.
The primary instruction is to scale in slowly in that $65 to $66 zone. This is crucial.
Why?
It lets you manage the volatility. If tech keeps creeping up for another day or two and pushes SQQQ down closer to 63, scaling in lets you average down your cost. You're acquiring more of that cheap insurance at even better prices.
And for a product like this, the hard stop is probably the single most important rule. What's the line in the sand?
It's a very strict, non-negotiable parameter. A hard stop loss must be placed below the 52-week low, specifically below $63.
So if it breaks 63, you're out. No questions asked.
You're out. It signals the buying pressure in tech is just too strong and the whole bear thesis is invalidated, at least for now. You exit to preserve your capital.
That disciplined exit is critical. But now we have to address the big caveat, the detail that trips up so many people with these products. Why is SQQQ specifically called a decaying asset?
This is probably the most important detail, and it's why this is a short-term trade only.
Okay.
Leveraged ETFs like SQQQ decay over time because of something called volatility drag. They have to reset their leverage every single day.
So walk us through that. Why does holding it long-term just destroy value?
Okay, imagine the NASDAQ goes up 1% one day, then down 1% the next. It basically ends up flat, right?
Right. Back where it started.
But SQQQ loses ground. On day 1, the index is up 1%, so SQQQ goes down 3%. On day 2, the index is down 1%, so SQQQ should gain 3%. But that 3% gain is now calculated on a lower depressed base price.
Ah, I see.
That compounding effect of the daily reset means that even if the NASDAQ just trades sideways for months, SQQQ will consistently lose value.
So it's an instrument purely for capturing quick directional moves.
Exactly. It's a scalpel for volatility, not a comfortable armchair investment.
Okay, let's talk targets. If the correction does play out, what are the profit goals here?
There are two. Target 1 is the conservative goal. $70. That's the immediate gap fill target we just talked about.
Quick bounce.
Right. Target 2 is much more aggressive, $78. This target assumes a real sentiment-driven market correction happens, something in the range of 5 to 10% for the NASDAQ.
And that jump from 66 to 78 would be a fantastic return, but it requires the kind of sell-off that really frightens most people.
It is a trade based entirely on anticipating pain. And the analysis is meticulous about scaling out of the position as it moves toward the target. Just like you scaled in, you have to lock in those profits.
Okay, let's bring this all back together for you. This analysis is arguing that the aggressive January rally in tech has created a statistically stretched market.
And that this setup positions the historically low price of SQQQ as a high-octane speculative entry, or even just as a tactical hedge against an increasingly frothy NASDAQ.
The broader lesson here, it seems, is about learning to read market psychology.
It's about anticipating corrections and understanding how these specific tools can be used to manage that volatility. You're using the chart and the fundamentals to see where the market is most exposed to fear.
It's a fascinating high-stakes case study in contrarian timing.
It is. And it all hinges on the discipline of the trade.
And that discipline hinges on that one crucial number.
The stop loss. $63. We've established this is just below the 52-week floor. And that raises a really provocative question for you to think about. What does it signal about the fundamental strength of this tech rally if the price of SQQQ breaks definitively below $63? If this whole reversal narrative fails and the inverse ETF hits a new all-time low, it would suggest the momentum in tech is so overwhelming that it has defied not just statistics, but deeply rooted technical floors. That $63 boundary isn't just a stop loss, it's the definitive line between a healthy correction and the validation of a much, much stronger tech bull run.
Don't forget to like, share, and subscribe for more.